right, thanks again for joining us here on the Tech Corner. I'm George Tsilis, Senior Markets Contributor here with the Schwab Network. On this week's edition, we're going to cover Qualcomm Incorporated. Now, Qualcomm is a global technology leader, primarily engaged in the development and commercialization of foundational technologies for the wireless industry. It operates through three primary segments. First off, its CDMA technology segment, called QCT, or Qualcomm Communications Technologies, Technology Licensing, or QTL division, as well as its Strategic Initiatives division. Now, Qualcomm Technology segment is responsible for developing and supplying integrated circuits and system software with advanced connectivity, high performance, and low power computing technologies for mobile devices, automotive systems, and periphery IoT devices. Its licensing technology focuses on Qualcomm's extensive portfolio of patents, which are essential for manufacturing and selling wireless-based technologies like 5G. Qualcomm generates its revenue primarily through the sales of integrated circuit products, including its Snapdragon family, through its licensing programs. The company has a strong presence in automotive technology, providing advanced driver assistance and digital cockpits that enhance cabin experience and connectivity as well. In the IoT sector, Qualcomm's technologies advance consumer electronics, industrial devices, as well as edge networking for data centers. Now, when it comes to competition, there are mainstay competitors that include Broadcom Incorporated, ARM Holdings, NVIDIA, as well as Intel and AMD. All these companies provide other various types of semiconductors, whether it's CPUs, GPUs, or licensing technologies for wireless connections. The unique value for Qualcomm lies in its comprehensive Snapdragon platform, which integrates application processors, modems, and wireless connectivity capabilities. This integration enables Qualcomm to offer a broad range of products that cater to mobile, automotive, and the Internet of Things markets. The company's strategic focus on artificial intelligence also further strengthens its position, allowing it to deliver high-performance, low-power solutions that meet the increasing demands for advanced connectivity and computing capabilities in various industries such as data centers. Now let's take a look at the most recent news for Qualcomm. Going back to February of this last year, the company actually posted its fiscal Q1 earnings and sales. Both the top and bottom line numbers beat expectations. For example, the company posted $3.50 a share. This bested the estimates by 10 cents, which were expected to be around $3.40. Revenues came in 17% higher year over year at $12.25 billion versus the $12.16 billion estimated. Now, despite the quarterly beat on both top and bottom line sales and earnings, the stock reacted poorly due to the revised lower Q2 guidance. The midpoint revenue estimates actually fell by $600 million to $10.6 billion versus $11.2 previously estimated. This also led to a midpoint adjustment in earnings guidance cut from $2.87 per share down to $2.55. The rationale was based on near-term handset sales outlook, which was impacted by industry-wide memory constraints, yet the CEO was encouraged by end consumer demand for premium and top-tier smartphone market growth from both Samsung and Apple. Now, in the QCT automotive segment, the company actually reported record revenue of over $1 billion, up 14.6% year over year, and up 4.6% sequentially quarter over quarter. Now, while chip handset revenue grew modestly year over year, up 3.3% to $7.82 billion, sequentially it was still stronger by 12.4% quarter over quarter. The Internet of Things revenue remains a strong growth driver, up 9% year over year respectively, albeit from a smaller revenue base than Qualcomm's core handset chip business. Now let's take a look at some other positives for Qualcomm. Despite market challenges, especially in the handset business, Qualcomm's diversification into the automotive segment has shown impressive growth, with automotive revenues, as I mentioned, up nearly 15% year over year in Q1 2026. The company's strategic positioning in artificial intelligence and its robust free cash flow growth supports shareholder-friendly capital allocation, offsetting potential revenue losses from Apple, which is eventually integrating proprietary modem technologies in lieu of using Qualcomm's modem chips. Qualcomm still expects approximately 70% market share in Apple's current iPhone 17 lineup, and it appears that Apple's rollout of its own modem technologies may not happen in full until its iPhone 18 launch later this year. Qualcomm also hinted that its baseline chip content with Samsung smartphones, presumably its flagship Galaxy models, sits at around 75%. Last year in 2025, the acquisition of AlphaWave aims to accelerate and provide key assets for the company's expansion into data centers to bolster its AI infrastructure offerings and provide a strong growth platform. Now, from an earnings multiple and valuation perspective, the stock is trading below its own historical 5-year PE ratio of approximately 14.55. This is also well below the industry group peers of 23 times earnings, while the current PE of the company stands at less than 13 times. Now, these valuation multiples are important in the context that they correspond to lower forward four-quarter earnings and revenue growth. For example, the next four-quarter sequential revenue growth of only 4.3% is less than its historical average of over 11%. EBITDA growth is still expected to grow more than 9%, but again, these numbers are lower than historical five-year averages of around 11%. Now, these growth multiples, which are lower than averages, alongside that earnings multiple lower than historical averages, may garner attention from institutional investors who are looking for value. Now, despite the positives I mentioned just a moment ago, we also have to always address some concerns. First off, the company is navigating challenges in the handset market, and its heavy reliance on the cyclical mobile phone market poses risks, especially with the anticipated loss of Apple modem revenue over the next 2 to 3 years, which presents a major headwind. Now, Apple is explicitly cited by Qualcomm as a major handset customer that develops its own silicon chips. This could potentially impact Qualcomm's future revenue and cash flow growth. Currently, Apple likely sits within the largest customer concentration cohort for Qualcomm, estimates of over 21% in the fiscal year 2025, yet these figures remain unconfirmed by Qualcomm itself. There's also some licensing revenue weakness. Last quarter, the company guided down to between $1.2 and $1.4 billion in fiscal Q2. This is down sequentially than Q1. Management cited this issue was driven by supply constraints for memory. This is important because the licensing technology division is a high-margin business, and profits in that division can swing wildly. Other risks include weaker premium handset demand, growing competition from firms like Huawei in China, and geopolitical tensions. It's approximated that 70% of sales are international for Qualcomm, and China customers are estimated to comprise around 40% of sales. This means that Qualcomm potentially faces significant exposure due to things like tariff restrictions and trade risks. Now let's take a look at the technical picture for Qualcomm. First off, the annual trend in Qualcomm's price has been down and weak, with one-year returns down 19.5% versus a gain of about 14% for the S&P 500. Year to date, the returns are down about 18%, which is also underperforming the semiconductor index, also known as the SOX index, significantly. Now, there's a near-term bearish trend in the stock. This is indicated with the price below its downward sloping 10 and 20-day moving average, as well as the 50-day moving average. And the stock has underperformed the market over the last 60 trading days when compared to the S&P 500. The stock is also trading below its 200-day moving average, which also confirms an intermediate-term bearish outlook. Now, when you actually look at a daily candlestick chart, the stock did fill the recent earnings gap back to the $144 level, but the stock has yet to reclaim its 20-day moving average, which suggests that near-term weakness still prevails. Now, despite the negative downtrend, upside momentum as measured by the weekly RSI is slightly above 30 and positive and beginning to strengthen. This is also diverging relative to price when looking at a 3-year weekly chart. Now, on the daily chart using MACD, this indicator is also diverging relative to price in a positive capacity. Lastly, I think the longer-term context in price action is meaningful. The company's stock recently tested the 200-week moving average. This price action suggests the stock may be in a bottoming process. However, it has not clearly developed into a major trend reversal for the bulls. Now, in summary for Qualcomm, we have to consider Apple's decision to build its own baseline chips or modems to displace Qualcomm, which may be a medium to long-term headwind for the business. However, this is not calamitous to Qualcomm as a whole because its other segments like automotive and Internet of Things segments are expected to continue to grow. Qualcomm has enduring strength in its silicon products and IP portfolio, and the company is poised to continue to be an industry leader in chipsets, which may help maintain a healthy revenue stream of high-margin revenue royalty growth over time. The other thing to consider is strategic acquisitions and partnerships continue to enhance its capabilities in AI, automotive, and the IoT segments, positioning Qualcomm as a key player in the digital transformation of these sectors. And lastly, we must consider Qualcomm's acquisition strategy and focus on energy-efficient AI chips for data centers and automotive applications are set to enhance its competitive advantage and potential shareholder returns for years to come. All right, that's it once again for this week's edition of the Tech Corner. Please don't forget to like and subscribe to the Schwab Network. I'm George Tsilis. We'll see you here next week.